Now, when you break above up any trend line of significance, you need to confirm, guys. I can't stress that enough. Otherwise, it could be a fake out, right? And the confirmation signal is something I created a decade ago to help me really isolate down when is it a real breakout versus potentially a fake breakout. And it's not to say that if it confirms it's 100%, right? There's nothing in trading that's 100%, but it basically takes the odds from one close above a line or below a line that it's a real breakout. People were asking, well, how do you get 1.8 as your multiple to figure out what the high end should be? And the only reason I'm getting that is because that's actually what the multiple is, right? So if you take this drop of 35.45 and you multiply it by 1.8, right? 1.8 times, you get this exact rally in 6 months. And this is important, guys. This was 6 months of trading, right? In 6 months, you got this number. So what I did is you basically say, okay, well, here's the rally was 1.8 times the drop, right? So now let's do the same thing. If we take this drop for Liberation Day, which was 21 and change percent, and we multiply it by 1.8 again, right? So let's do that again. We multiply it by 1.8 times. Interestingly enough, what do we get? We get the exact rally that has occurred in the S&P here. And more importantly, it's like, listen, I mean, there always can be over time, but in exactly 6 months. And that, my friends, is interesting. The Nasdaq 100, I have this trend line that goes back to the COVID lows. It goes right to this pullback where we bounced, we broke, and then look, every time we're hitting, we're getting a pullback. Now, what's interesting here is that if we look at the pullbacks off this line from the underbelly, let's look at how big they are. This one was a 16% pullback. This pullback was a 25% pullback. So again, the question has to be asked is, should we be looking for something in one of these ranges? Or maybe if we average these two numbers, could it be as big as a 20% pullback? Right? I mean, if you take 15 and 25 and you average them, it's 20. Now, listen, again, could it be 15? Could it be 10? Yes, it could be any of those. But as a technician, I'm always thinking about the possibility. So the dollar is getting a big bounce again today. I find that interesting. So the dollar again, when the Fed announced their cut, we dropped initially, then we rallied back. We did have a couple pullback days on the dollar, but now the dollar is actually starting to turn up even more. That is interesting to me because, again, in theory, with the Fed cutting rates, most people would assume, oh, the dollar is going to weaken and the 10-year yield is going to go lower because the Fed's lowering rates. It's not doing that. That also is something that is piquing my interest potentially as an obstacle for the market. The 10-year yield, same thing. This was your low on the Fed. It rallied up. We had a pullback yesterday. It's going right back up. Interestingly enough, look at this. We closed above. We didn't confirm above this trend line. And there we did confirm. So yesterday when we pulled back, this became major support because we confirmed above it. And sure enough, we're getting a bounce over it. Obviously, I'll continue to monitor it. I love looking at this daily 10-year yield chart on the weekly. It just looks so much better in terms of how crisp this trend line is. And you can see that even though you pierced it, you keep on getting bought up. The yields keep coming back up. And again, folks, the reason why yields going up when the Fed is cutting rates is so bad is because basically what it's telling us is that, number one, either the market thinks inflation is going to go up and the Fed won't be able to cut as much as they think, or it's telling you that foreign buyers of U.S. debt are not willing to purchase our debt for lower interest rates. Like if I'm a country, right, and I'm like, oh, I got a call from the administration saying would I like to purchase, $50 billion of treasuries. Am I going to be okay on a 10-year or a 20-year only getting a 4% interest rate, even though I look at the U.S. debt and I'm like, dude, these guys, what are the odds of me actually getting paid back? Maybe pretty low. I want a little bit more in interest to take that risk, right? Remember, when you're given interest, the higher the interest rate goes, you're willing to take a little bit more risk on that debt. Like if someone said, hey, listen, you know, I have to sell some debt here. Would you like to buy this? Listen, my company's not super firm, so there is some risk. You're not going to be like, oh, sure, I'll you pay me 1%, I'll give you this money. You're going to be like, give me 20%. interest, right? Then I'll take the risk. That's the point. That's what's going on here. And that's the risk in the market. There are more and more topping tails forming. Topping tails, if you're a technician out there or if you're learning, what is a topping tail? It's a bearish reversal signal. Yesterday, we had topping tails galore in many, many charts. What were some of them? Right here, the Dow Jones Industrial Average. This is a topping tail. That is a bearish reversal signal. Now, what's amazing is we're still stuck inside of this tight wedge, but basically, there's no place to go. Like, we're either going to have to break above or below this wedge. And you now have a topping tail here. So, this again, more and more signs that the Dow looks tired and potentially going to break down.